Listen, if you're tired of sifting through endless spreadsheets and confusing metrics, this video will change the way you analyze stocks forever. You don't need a PhD in finance to figure out if a company is worth your money. All you need are two simple ratios that professional investors swear by: ROE and ROIC. With these tools in your pocket, you'll stop wasting time and start making smarter investment decisions. Now I get it. Investing can be overwhelming, especially when you're bombarded with financial terms and dozens of different metrics. You've got your PE ratios, EBITDA, cash flow statements, dividend yields. It's enough to make your head spin, right? But what if I told you that you don't need to analyze 50 different financial ratios to determine whether a company is worth investing in? What if you could focus on just two simple metrics to get a clear understanding of a company's profitability and efficiency? That's what today's video is all about. When you're investing, you're essentially placing a bet on the future success of a company. You're giving them your hard-earned money, trusting that they'll use it to grow, innovate, and generate profits. But how do you know if the company you're investing in will actually give you a return? That's where return on equity, ROE, and return on invested capital, ROIC, come in. These two ratios will help you determine whether a company is profitable and efficient, and they'll give you insight into how well management is using both shareholder equity and borrowed capital to generate returns. By mastering these two ratios, you'll be able to make quicker, more informed decisions about which companies are worth your money and which ones to avoid. I'm going to show you how they can make your stock analysis quicker, easier, and more effective. By the end of this video, you'll be able to assess a company's financial health in just a few minutes. ROE, the first key to assessing profitability. Let's start with return on equity. ROE is one of the most important ratios for investors because it measures how effectively a company is using your money, its shareholders' money, to generate profits. Think of it like this. When you buy shares in a company, you're not just a passive observer, you're an owner. The company is using your capital to run its operations, grow its business, and hopefully make a profit. Return on equity tells you exactly how much profit the company is generating with your investment. The formula for ROE is straightforward. ROE equals net income divided by shareholder equity times 100%. This formula gives you a percentage that shows how well a company is performing relative to the amount of money shareholders have invested. For example, if a company has an ROE of 15%, that means for every dollar you invest, the company is generating 15 cents in profit. But here's the key. A good ROE is not just about a single number, it's about consistency. Let me explain why that's important. A company might have a high ROE for 1 year, but if that number fluctuates wildly or drops in the following years, it could be a sign that the company's profitability is not sustainable. Consistency in ROE is often a sign that the company has a durable competitive advantage, something that allows it to outperform its competitors year after year. Companies like Apple, for instance, have maintained high and steady ROEs for over a decade. This consistency is what makes them reliable investments. If you're seeing an ROE above 15% and it's been consistent over the past 5 to 10 years, that's a big green flag. ROIC, the second key to efficiency. Now let's talk about return on invested capital, which adds another layer to your analysis. ROE is great because it shows how well a company is using shareholder equity, but ROIC goes a step further by telling you how efficiently a company is using all of its capital, both equity and debt. Why does this matter? Because many companies rely on borrowed money to fund their growth. ROIC helps you determine whether the company is using all its resources efficiently to generate profits. Here's the formula for ROIC. ROIC equals NOPAT divided by invested capital times 100%. NOPAT stands for net operating profit after taxes, which is just a way of measuring how much profit the company has after taxes and debt repayments. Invested capital includes both shareholder equity and long-term debt. A good ROIC is typically above 10%, and anything higher than that indicates that the company is efficiently using its capital to generate returns. Why is this ratio so important for investors? Let's say you're comparing two companies in the same industry. Both have similar ROEs, but one has a significantly higher ROIC. The company with the higher ROIC is likely the better investment because it's using both its equity and debt more efficiently to generate profits. Think about companies like Google. Google consistently reports an ROIC well above industry averages, reflecting its ability to turn every dollar of capital into substantial profit. It's not just about how much money a company can make with shareholder funds, it's about how well it can make money with all of its resources. That's the real measure of a company's efficiency, the power of ROE and ROIC together. Here's where the real magic happens. happens. When you combine ROE and ROIC, you get a comprehensive picture of a company's financial health. ROE shows you how well a company is using shareholder equity, while ROIC tells you how efficiently it's using all of its capital, including debt. When both ratios are high and consistent, you've likely found a company that is both profitable and efficient, an excellent candidate for long-term investment. But here's the catch. Not all high ROEs are created equal. A company might have a high ROE, but a low ROIC. This can be a warning sign that the company is taking on too much debt to boost its returns. When companies borrow excessively, they can shrink their shareholder equity and make their ROE look artificially high. But in reality, they might be over-leveraged, which could hurt their long-term prospects. That's why it's essential to always pair ROE with ROIC. For instance, let's look at Tesla. Tesla has shown strong ROE numbers as it scaled its production and began turning profits. But if you dig deeper and look at its ROIC, you'll see how efficiently Tesla is using not just shareholder money, but also its considerable debt. Over the past few years, Tesla's ROIC has improved, signaling that it's not just growing, it's becoming more efficient as it scales. On the flip side, if you see a company with high ROE but flat or declining ROIC, it could be a sign that management is relying too much on debt to prop up returns. That's a red flag for investors, and it's something you should avoid. Common pitfalls. Don't be fooled by manipulated numbers. Now, before you start relying solely on these ratios, there are a few traps you need to watch out for. First, some companies manipulate their ROE by taking on too much debt. Why does this happen? Well, when a company borrows money, it increases its liabilities, which can shrink its shareholder equity. With a smaller equity base, the ROE looks higher than it is. It's a clever accounting trick, but it doesn't reflect the company's true financial health. That's why you need to compare ROE with ROIC to ensure that the company isn't masking poor capital management behind inflated ROE numbers. Another common trick is share buybacks. When a company repurchases its own shares, it reduces the number of outstanding shares, which can make earnings per share and ROE look better. But here's the thing, if the company's overall profits haven't changed much, this is just window dressing. It's like trying to make a small pie look bigger by cutting it into fewer slices. Sure, each slice looks bigger, but the pie is still the same size. When you're analyzing stocks, always be on the lookout for companies that are using buybacks to inflate their ROE without actually improving their business fundamentals. That's another reason to always check ROIC alongside ROE. ROIC accounts for both debt and equity, so it can give you a more accurate picture of how efficiently the company is using its capital. Take control of your investments. So now that you know the power of these two simple ratios, what's your next move? Take control of your investments by analyzing ROE and ROIC for the stocks you're considering. Don't just rely on headlines or hot stock tips. Use these ratios to make informed decisions based on data. If you're ready to put this into practice, check out the tools I've linked below that can help you easily calculate and compare these ratios across multiple companies. If you found this video helpful, hit that like button and subscribe for more in-depth investing insights. Share this with anyone who's tired of being overwhelmed by the complexities of stock analysis and is looking for a simpler way to invest smarter. Thanks for watching, and I'll see you in the next video.